Welcome to our new episode of Blockrevision. Today we will talk about housing market. What's going on with housing market that might be the premise, the problems on this market might be the premise of the upcoming storm in the economy. And today, as always, about stock market, commodities, major indexes, and where we are right now in terms of risk environment. So let's get to new episode. Let's start with what's going on in the housing market. So Blackstone has some problems. Blackstone, a leading global investment business, investing capital on behalf of pension funds, large institutions, and so on, so forth, has some problems with its housing market. So it found that right now, due to the lower consumption and the lower appetite for that type of assets, we are right now in the midterm of upcoming storm to the markets. So in the past decade, the real estate industry was the one that reaped the benefits of the Federal Reserve policy of low rates. Home buyers, taking advantage of record low borrowing costs, went on a spree that fueled double-digit price gains. Now real estate has been among the hardest hit sectors of the Fed's campaign to quash inflation. So I will just extend the field for you. Right now we are going through somewhat realistic pullback of responses to the overall economic weakness that we are seeing, and that's due to a spike of interest rates. What you can find right here is that United States building permits is projected to look fine during next months, next quarters, but these are just projections that are somewhat optimistic. Just look at another data. I will extend it once again. Housing starts, existing home sales, as well as new home sales in United States, and pending home sales are forecasted by analysts to have its good time ahead. But right now we are still nowhere near from stopping interest rate hikes, and also quantitative tightening is the one that may last throughout at least 2023 if nothing breaks to the economy. That's why Fed is taking off the table $95 billion every single month, and that's something that also been not indifferent for Americans' pockets. So from my stance, that projections that are marked with a gray line, that right now finding out that's too optimistic to rebound it from here. If you just have a look at what happened during 2008 housing market, we had such a breakdown that had last at least throughout 2 years. Maybe we won't have such a fall this time, but definitely we haven't yet faced such difficult conditions in the economy. Let's jump to another slide, what we got out there. So we can find that disruptions of the pandemic, which triggered massive job losses as well as a spike in housing costs, driven an unprecedented shakeup in living arrangements, and right now more and more young people are living with adults, and that's the trend that has skyrocketed recently, and that's nothing that stops it right now. Due to this, I find that these projections of such a V-shaped rebound on pending home sales due to recovery of economy for me are too exaggerated to the upside. So we should take attention to this, especially with that many companies had with Wells Fargo and other large players on the market in the market industry right now are suffering from major layoffs. So the headwinds might be ahead. Right now, let's get what's happening on the ECB's side. Right now, ECB is on thin ice in terms of its stance of the market. Right now, Europe is facing over 10% inflation, as well with market energetic crisis. And despite this, ECB is set to unwind bond purchases made since 2015. So we are not only finding out ourselves in the most difficult economic times throughout recent years. Euro area haven't ever faced that high inflation, and also we are, due to this problems that we are facing right now, there's Italian crisis and other things that may break market tranquility, is adding up. We need to take those money as Fed already started to take in United States with projection yet to deliver in December. So that's quite difficult time ahead ECB's governors, and that's what I would like to also relate to in the next episode. So if you haven't subscribed yet, just you may do it right now. Okay, what we got next is market outlook, and in terms of market outlook, we are right now going through that what the banks are doing. So right now, risk reward for many banks with Morgan Stanley and JP Morgan at the front is quite poor at this point, what they found. Morgan Stanley, needless to say, will cut about 1,600 jobs from global workforce. They finding out that major headwinds in the economy might be yet ahead of us. That's why they are cutting their positions and right now expecting another leg downside. That's why you need to be very cautious, as you better not bet against such large entities. So markets, if you would like to just also ponder this over, markets haven't never bottomed before recession has begun. Right now, many entities of economists are finding out that we are still not in a recession yet. So after such a breakdown of 27% in SPX, that's definitely the thing to that is returning like a boomerang, is when those bottoms might be yet to get marked. Okay, market movers section. Let's jump to okay, in terms of market movers section, let's find out what's happening on calendar of economy on Wednesday. Let's maybe jump out to all right, kicking on GDP growth rate for European Euro area is the one that is also sliding, what we can find right there. Right up next, you have had Bank of Canada interest rate decision, and that was at 0.5%, so we are crossing 4% right now. And right after, we have on Thursday initial jobless claims that is yet to deliver tomorrow. Okay, so that's what I would like to take a look at with a kind of high attention. Okay, let's jump right now to a trade idea. And in terms of trade idea, I will have for you 1 second. I will have for you a let me switch the panels. 1 second. Okay, so we are jumping back to. Okay, so right now, if you finding out DXY is in the partings of its ways right now, before deciding where does it go. However, many of indexes right now, major indexes, are about to decide which way they wanna go. Right now we can find that we have built up a lower lows on DHI. Also US 100 breaks to the downside, but still holding this not very strong downward line, but still trying to get it through. However, there is very little time for this one to rebound, as it had its time, at least had its chance at least 2 times, but after building up this double top formation right now, we are more likely going downside than upside, and the next stop is somewhere around 10,800. So adding this through, I would bet US 100 that it will cross downwards and move down this recent price box of this what formed right here, starting with 14th of November. Right now we are after 3 weeks of this consolidation, right around here, and the next stop for this formation, in my opinion, is right at these bottoms. So if you wanna just to put a trade board I would make it like here with risk reward ratio at 4 points. So if you wanna just check out, that's exactly US 100. That is about to slide downwards. The stops are right above this recent spike made on 9:30. So I do expect this one to slide at right from this level. So in terms of trading area, I would make it right here. If the price somewhat cross any of those boundaries of the blue box, I wouldn't consider this proposition of a trade as valid. So in my opinion, that's for today. If you have any questions regarding the episode, this short a bit episode, just put it in the comment section below the video. Or if you enjoyed, just hit the like button. Thank you very much for today, and see you tomorrow, 8:45 to 9 a.m. East time. Bye bye.